Our Labor Day sale is now on. Join Club and save $300. Link in the description. Well, hello, greetings all. Let's see, we've got macro to micro options power hour starting now. As the same time, we've got Nvidia reporting after hours. We'll talk about that in a little bit. But first they need to get kind of out of the gate, and then we gotta do a little market reaction, and I don't know what else. But last time we did this on a big tech earnings release, it was Microsoft. And anybody who knows, we were doing this live, and I said it looks like a fabulous, if you're long, basically capture those profits by shorting the stock after hours, because I can see this coming back down in a gap fill in time back to 500. And that's exactly what it hit 2 days ago. So it took a little bit of time, but now we've got Nvidia with a potential 7% expected move. Premium sellers typically win. We're going to talk through how to play that after it announces. But for right now, I'm very much expecting a retracement down to 172. So long story short, for me, it's not a question of even after this release. I don't care if it hits 200. I still expect it to come back down to 172. It's not a question of if, for me, it's just when. But what it does under 172 for Nvidia is what really matters to market returns, and we're not there yet. So anyway, we've had lots going on. Since last Wednesday, we had Powell threading the needle in regards to employment and inflation and rate cuts. Oh my, lots of interpretations, dovish, hawkish, I have mine. Then we had Monday afternoon, after market close, we had Trump basically fire Fed Governor Lisa Cook and all that entails, which is basically a legal fight. And then whether this is a precursor to him having grounds to hit Powell, either firing or demotion, there's a bigger play. This is definitely Fed independence getting attacked in addition to facilitating an agenda of rate cuts, which right now he doesn't have the numbers on the FOMC committee. So he will, after Mirren, who will be reviewed. In other words, he's been appointed but needs to be approved. So if that goes through and he gets a replacement to Cook, he will absolutely have majority on the FOMC. So it is management by committee. Anyway, we will continue to have fiscal easing, monetary easing. Nvidia is likely to beat top line, bottom line. How are their margins? How's their guidance? What about China? Oh, I could talk a lot about what about China. But we also have economic data after this report of Nvidia on a Wednesday. We've got PCE coming in, which is Fed's preferred inflation guide. But we also have non-farm payrolls coming in September 5th, which is supposed to be very eventful, and the market will probably chop a bit ahead of that. And the reason I say that, and I'm breathless trying to get this all done so I can throw it over to you, Hans. But the reason why I say that is because Goldman is expecting a hit to job growth like we had on August 1st, which was a revision for the prior 2 months. Well, Goldman is now expecting that the next non-farm payroll report, assuming we get it, because we have a new BLS director, will produce a job growth revision somewhere between 550,000 and 950, which would be ginormous and much bigger than the revisions that hit of 818,000 last year into the September 18th surprise 50 basis point rate cut by the FOMC. So guess what? It's not a surprise that Powell said we're a little worried about inflation, but we're also really worried about the labor market a little bit more than we were, et cetera, et cetera. So don't be surprised if they cut, because they're justified in doing so because of labor weakness. In the meantime, inflation takes a little bit more time to produce results. And long story short, they are moving their inflation goal after 52 or 57 months of 2%, 2%, 2%. They're now pushing it higher. Not a surprise. Lori Logan, who joined the board years ago, said that's ultimately where we're going to have to go. And we are. So I've reviewed very quickly the fact that we are waiting, anticipating for market reaction to Nvidia earnings. We have Jackson Hole out of the way. That is a major market mover. So is Nvidia as golden child of the semiconductor space. But we also had minor market moving events, which was in large part options expiration. I warned, big stack on July 31st. We had shake and bake. And again, into August 15th, options expiration. We had also shake and bake into the VIX expiry Wednesday morning, which was the 20th, before Jackson Hole on Friday where Powell basically sounded like he was punting, but he's basically sending a warning sign that labor market matters and it is weaker than we think. Okay, hopefully that catches you up. Hans, take it away. What are you looking at?
Well, I don't know. We've got a couple things where William said hang in there, Han. So I'm not sure. I'm not sure why I need to hang in there. But is there something behind me? I'm a
It's
little
me.
worried.
It's me. It's
Michael
going,
says
going, going. Energizer Bunny. Okay.
Michael says drop the L in BLS because it's just BS, and I like that. That's a good one. And my snow turbo is looking good right now. Yeah, I haven't looked at the price, but snow's been one of those curious ones where I'm
Woo!
like, this
224. 224. That is the prior high back in the week of August 1st. We actually, no, not prior high. We hit 229, but I'm
yeah.
pretty sure
Okay,
we're
good.
gonna
Yeah,
go, we're gonna
Snow's
go
kind of
there.
the mini Palantir, slightly different take on it, more data silo kind of management, insight, not so much insight. They work with Palantir sometimes. But anyway, it's good to see that because it hadn't been acting well, and it is one of picks, my AI picks. And what I thought was interesting, Samantha, was this MIT study that came out, which is about a year early. I mean, anybody who's coming out and saying that we're not seeing anything from AI is really kind of missing the point that this inference phase is really kind of the first pitch of the first inning, maybe even in the parking lot, walking over to the ballpark, is kind of where we're at in that stage. I mean, the way this is going to play out in enterprise. So it's no surprise that people are kind of going, well, companies aren't figuring it out. Really? You're not paying $20 for your chat GPT every month and suddenly running your whole organization with that? No, of course not. So it's complete and utter nonsense. This is just getting going. And I think it really argues for, in fact, I think it argues for the Snows and the Palantirs, even though Palantir is just beyond stupidly priced. It argues for the idea that there's going to be a fever in terms of companies, enterprise wanting to get involved, not really knowing how, and calling like, who's the fixer in Pulp Fiction? Harvey Keitel. You call that guy when you've got a problem. I don't know how to use AI. I want to make it work for me. And so you're going to call companies that can help you figure that out. So I think the TAM is absolutely massive in those. But overall, yeah, I mean, you're right. It's sort of been nothing really doing lately. I am looking at, we talked about a few weeks ago, right before that jobs number came out, and we had that little dip, and we were sort of talking about how it was very unnatural for it to be so easy selling these short-term puts, these 0 DTE, 1 DTE. And in fact, I had somebody reach out to me looking for some help, and they said, yeah, boy, that was a really easy period. And then I kind of got absolutely smoked on that jobs number. And that's the risk, is that you kind of get to a point where the premium starts to get a little thin. We know the VIX is down in the 14s. You made some great calls on where the VIX is going to get to. And what we're seeing is really that sort of warning sign that I mentioned that very Wednesday when I said, oh, you got to watch out. In my time, over the years, I've seen where that realized volatility just gets very, very quiet, and that gap between actual market movement and the VIX and other sorts of pricing gauges that just don't want to come down, that gap gets very, very big. And so we can see somebody put out, I think it was B of A, they put out the VIX 1 month futures to spot spread. And that's really what we're talking about here. So for those of you who don't know what that is, the
Mm.
VIX futures are upward sloping. They're kind of pricing in where they think the VIX is going to be in 30 days, 60 days, 90 days, et cetera. And they're in a beautiful, beautiful shape. There's no arguing that the shape tends to be bullish for stocks. I mean, or it's stocks are bullish, therefore the shape is there. So we're always kind of having this conversation with the VIX, which is, well, you should buy stocks when the VIX is low. Well, it's kind of the chicken and the egg a little bit. The VIX is reflecting sentiment in stocks. And so it's a bit of a circular thing. But there's no question that everything's kind of looking very, very calm. But that sort of indicator that I like to look at, which is it's almost a little bit too calm versus where the pricing is. So we've seen that gap actually expand out to pre-2023, early 2023 levels, so late 2022 levels, in terms of this kind of indicator that things are extremely calm, nothing to see here. So that's always when you kind of have to have your antenna up and maybe start to think about hedging. We've been talking about that, and there's no question that hedging is often money in the toilet, and that's how you kind of have to look at it, because it's a bit like your house insurance. You don't mind seeing that house insurance go to zero every year, because that means that nothing bad happened to your house. So that's how some people look at it. And we can see that steep skew in S&P puts, that put skew
Hmm.
is very, very steep as people just kind of stay long and protected, long and protected. Sometimes people look at those put numbers and they go, oh my goodness, everyone's bearish. Look, they're buying puts up the wazoo. Sometimes it just means, oftentimes it more means that people are just kind of staying long, staying protected, and really worried about missing the upside. So, and we might have other ideas around that. So it's been a very kind of as expected expected sort of just continuation of the melt up lately. I'm not doing a ton. I mean, I've got a few strategies that I've gone into Nvidia with today, which we can talk about just for fun.
Yes, we not for fun. This is fun and games
Games.
until money's involved. So,
Right.
how are you playing this lovely because this is the thing. You know how I am about earnings. I have no edge with earnings. It's mostly after it reports, I have a very strong edge. So, after it
Yeah.
reports, I know what I'm doing with it. But what do you think? How are you positioned?
Well, and they had a guy on CNBC today, and he said, I love to sell calls into earnings, and normally it's really good, but today we're not because we really like Nvidia, and we're not doing that. The truth is that selling calls into earnings is actually usually a negative edge trade. So people who do that think that they're getting all these wonderful, juicy premiums. But if you look at the studies, they show that on balance, that doesn't mean any one individual situation may not reap the reward. On balance, you are facing something that the upside tends to be underpriced. The downside, not as much, but I don't really like doing either one of them unless you start to use a little bit more complex structure, maybe a calendar or something that's going to play a little bit of a move up, but a compression of option pricing. So long little vega, short little gamma, that kind of aligning your Greeks or broken wing flies. So I put one on today on CRM. So playing that. Anyway,
Mm-hmm.
before we get into that, let's go back to NVIDIA.
Yeah.
So into the print. So I've been long a lot of NVIDIA, SOXX, and some of those sort of semiconductor plays because as everybody knows, I've been very sort of bullish on the infrastructure build out over time. And I'm no less bullish in a sense at this point.
Mm-hmm.
NVIDIA's run from 130 to 180, but if I could have things my way, I wouldn't mind seeing a little pullback, $20 to your spot, Samantha, maybe 172, maybe a little lower. Some sort of, I mean, we're probably going to see a positive effect from the China write-off, maybe coming back in a little bit, but maybe there's some sort of warning or we don't hit the whisper number or whatever. But longer term, I like it. So I've gone in. They're not really looking for a very big move today. You mentioned it's about 7%, I think. So it's not abnormally large. I looked at some calendars. I don't really like the way they priced. I'm not getting a ton of value on the short side because it's not priced extremely crazy. And I don't love the long side of the calendar. So I didn't really do that. I didn't make that play. So what I did do, however, is I moved some stock positions into some in the money call positions. So sort of stock replacement strategies that sort of monetize some of the money that I've made in long stock and in various proxies, semiconductor proxies, and replace those with something like a next year, September, June, 150 call, 155 call. So you're kind of taking off $100 of risk and maybe replacing it with $3, 350 of risk in a sense, and maintaining a kind of similar exposure. I think the longer term option prices are low. You put that out this week, Samantha. I noticed on social media just talking about how we've been discussing how some of those upside calls have not been expensive and
Mm-hmm.
you could have said that for the last 800 or 900 points. And the fact is that generally they're not that
True.
expensive. They're
Yep.
just not that expensive. And that's
As VIX is falling, it's very, I want to say it's not easy, but it is very easy to stay with the trend long as VIX is falling. And it is, in fact, a 69% decline in the VIX over the last 20 weeks is the biggest volatility crash in history. Hat tip, Charlie Biello. So we really have had, and hedge funds are so short the VIX at a rate not seen since 2022. Now, 2022, we didn't have a big VIX extravaganza. We had a grind higher, and it was very unlike the yen carry trade unwind of July 19th into August 5th, where it went to what, 65, or the most recent explosion, the April tariff terror, which caused VIX to go to 60. They're talking about that particular one before Trump came in on the 9th and said, okay, we're going to delay these tariffs. It has been falling for 20 weeks since then, and they have continued to pump the market with lots of policy intervention. So VIX has been grinding lower, market's been grinding higher.
I have to admit, when it was coming down, I remember we were on with Brent, and I said, Brent, do you think 30 is the new 20? And
Mm.
he said, maybe. And I'm not pointing out Brent being wrong. I kind of thought maybe that's the case too, at least in the short run, because it's very difficult. I would have said that too, that we're going to sort of maintain a higher
But from a
level.
macro standpoint, it would make
Yeah.
a lot of sense for the range to be moved up, assuming there's no policy intervention. You know how I always say it is a macro event trigger we need to interrupt the bullish flows. Otherwise, be bullish. So watching the administration pile in with tariffs, indiscriminately, it seemed, would cause a market repricing of growth. No question about it. And if those were to stick, there's no reason why VIX couldn't have created a new higher level. But they unwound all of that. So this is why another form of accommodation is everything that they're doing since on the policy front, from short duration treasury issuance to all this talk of recent of Besant saying Fed's going to cut 50 basis point in September and 150 to 175 basis points overall. There's such a big push of lowering the monetary rate structure that the market has priced that in as well. And all of this coincides with a very weak dollar. So this devaluation is in full view. Debasement over deflation is in full view. So all the macro triggers to keep the market bulled up, not to mention we've had mechanical buying as far as the eye can see, and we've had very sticky yields, but they haven't spiked higher. So as long as oil is sticky, in other words, flat to falling, speaking of a new range, you know how I'm about that. Since last year, I see crude oil falling into the 60 to 40 range. We already hit 55 and bounced back up to 62, 65, but we're in a new lower range for oil. There's no reason why we can't be in a new higher range for VIX, except we had non-stop intervention for policy to keep the market bulled up, and corporate buybacks were hot. Now we're going to get to see September issuance coming in. Nvidia's down, by the way, down to 173. And I should stop talking about corporate issuance, but we're going to go back and talk about that. Okay.
Yeah, that's an interesting point because I think on the one hand, I see option pricing as generally inexpensive, given that I really think we're in a bit of a regime shift. I think that's what sort of throws everything up in the air. Do you want to take a look at Nvidia right now?
Yes, I do. So we were looking for about 46 billion in revenues, roughly $1 a share in adjusted EPS. Top line, bottom line expected to beat. After hours, we've got adjusted EPS is 1.05. Second quarter revenue, 46.7 billion, so in line. This is the margin was very important for me to see. Adjusted gross margin, 72.7%. I think last time was like 71, 72. So we're still in the ball game. And then Q3 revenue is expected to be 54 plus or minus 2%, which is exactly what was expected, low 50s billion range. So they didn't crush it. They met. The big picture with Nvidia, at least for me, is this guidance where they say we still have surging demand, which is why they printed well on data center. We know this AI-focused data center build out is strong orders from hyperscalers. This is the reason for the season. But I'm looking, that's all enterprise customers. I'm also looking for their guidance as it relates to the Trump administration coming in saying we're going to take 15% of your top line. Again, to be negotiated, but still it's a threat. China. Let's talk about China. China doesn't need Nvidia. The source of growth for Nvidia since early 2024 into 2025 has been China. So whether they can accommodate through different chips or continue their bypassing of sanctions through other countries, you could look at the flow of chips from Singapore and Malaysia into China. It's fully backdoor. So long story short, it's getting hit even though Nvidia is fine. Now, so you know, the way that I recommended playing Nvidia wasn't directly with options because all I care about is after earnings coming into and 172 and whether it can get and stay below. If it can get and stay below 172, we're in a we're in a really nice breakdown type of swing short reversion to the mean level all the way to 152. Well, what do you got this right now? You have literally you've got a low of 171.86. That's called 172. So one way that I suggested was the Qs would get hit on a pullback to that 172. So my suggestion was short the Qs for a Nvidia event. But we're still not inside 172. All we did was come back to 172. Now we need to get
Nice call. That was a nice call down to 172.
I know I'm really specific, but that's not important. It's important that we get below 172 and we stick that landing. Then we're going to drop $20. That's more fun for me. It's not gaming earnings. I don't like that game. The edge is not there. You can play it because you love all this advanced option stuff when it comes to earnings play. I like set it and forget it option stuff like the ASTS. That's like sock drawer, leave it. It's doing great. But this is different. I think we get break 172. The market is going to have more volatility and it's time a little bit more shake and bake.
Yeah. And also, Samantha, I'm just switching over to a different computer here, so
Hey, go
just look
ahead.
out for me. My screen's completely off here. But I'll say we're also looking at a very interesting profile from a gamma perspective where we're sort of in a very thick cradle of support sort of gamma environment where we are in the S&P right now. Now, if we get above 6550, 6600, I think it is, then we really start to have the potential for an accelerant to the upside with very, very little gamma or negative gamma. But similarly to the downside, below 6400 is where people keep talking about that sort of that 6400 is that last stand where below there we start to get a bit of a potential for an acceleration. So is this event enough to get us down there? I
No,
don't
not
know
until
about
we break
that. Yeah.
172. No, we did this. Let me just show my chart real quick on this while you fix your screen.
Okay.
I can see you. Yes, yes, yes. So on the
Perfect.
SPX, just real quick, this was a short that I had recommended in the room. We needed to get back below 64.45, and then absolutely we were heading down 84, down to 63.41.08. So it's going here. Next time Nvidia breaks that 172, we're heading right back into this area. Now, at the time, I didn't know this, but Jason from Volland in our contributor channel, he had posted right here when SPX hits that 63.50, massive amount of puts were sold. And that's why we bounced and stayed very firmly above that key level of 63.50. So I did not get my 63.41, but we will go there. So this is SPX, by the way. This does not show you what's going on after hours. What you have after hours is Nvidia, of course. They're monetizing already, whatever. They were protecting. They're buying it at the 172. You cannot see it here, but this is a weekly. This is my 172. So let me just bring it over here real quick. It literally tagged perfectly. Look at that. So that's what I'm expecting. We digest here, we roll back over, we break the 172, and we're going to go back in. That's where the fragility comes in to SPX, is once we get that weakness in SPX below that 63.41. Then we're going to have a little bit more air pocket. And might I also read something else that Jason posted in the channel? This was interesting that Jason also posted this morning. What happened earlier, and maybe you saw this, maybe you read about this, I don't know, but yesterday we had a kind of a big air pocket. I don't know if you remember, toward the end of the day, all of a sudden there was like a big selling event. Well, he writes, roughly 250,000 September OPEX options were rolled out to December. Now, why did this? They were the 6,000 by 6,500 and 5,000 strikes. So this, just for reference, the JP Morgan spread is 120,000 options. So this was twice that.
Wow.
Now, why that matters, and many people did not see this or catch this, but this is what his software, this is what he does. So he's an RIA and he's working with dealer levels that are much more nuanced and sophisticated than anything you can get anywhere else, which is why I love his interpretation, why we're so lucky. Really, LaDuc clients are very lucky to have this interpretation. He's also a great guy. But anyway, and then we have all the spot gamma tools. This is very retail friendly and there's just a ton there. But this is one thing that Jason does extremely well. So anyway, he says this has major implications on the customer and the dealer side. Now I'm reading from his report, so bear with me a little bit. He thinks a little research showed that this was likely an MSCI rebalance effort. One way or another, it is unequivocally a bearish move. So it is increasing the negative deltas. Volume leaders also saw major trades across the equity side, likely sells. This might be due to the rebalance effort. And by the way, before that, he did not see this. So he was still 6,500 for September OPEX. I'm not worried. All of my stuff still says strong. Breadth, buying, rate volatility is suppressed. FX volatility is suppressed. Equity volatility is suppressed. I have seen nothing, man. So when he said this, when he wrote this yesterday, I'm like, well, that's interesting. So let me go on. He goes, those calls could be dealers since that move increased dealer positive deltas, and that means they would need to sell in order to balance their books. So you can talk a little bit about this, and obviously we still have the JP Morgan collar, which I think is 6505. I'm pretty sure it is for September
6505?
OPEX.
Okay.
Yeah. So we can go there and tag it. So that's not the issue. The issue is what happens if we get a dramatically lower aggregate Vanna print that's, and he says this. So it's basically instead of what we're doing right now, which is crawling up, which is fine. And I can show you a perfect example of that in SPX. We have been really crawling up, which is you don't short a trend that's just 45 degrees up and to the right. It's gorgeous. On the weekly, I'm talking because I'm more of a trend swing trader. The point is, he says there is less resistance to a sell-off, and that's the point. So you can have a big move above 6505, But if we do have any wrench thrown into this, like non-farm payrolls coming out on 5th, will they produce a report or won't they? What about Cook? Is she going to be allowed to weigh in with a decision for the FOMC? What about China? They're meeting this week. Now, very bullish would be if China-US trade discussions go brilliantly, market's going to go raw, right through it. And we can go bullish, melt up, which is what you're still bidding for and why the calls are so dang cheap. But that is a wrench. And I just wanted to get your thoughts on that. I know I'm springing this on you. But if we do have any weakness, that's 64.50, where they sold puts very aggressively intraday to defend that level. If we give sway below that 60, which I have is that 64.41 that I just showed for SPX, I see an air pocket of risk below that. And it will be absolutely easier to get there if Nvidia gets below 172. And I'm not done yet. I'm watching the dollar yen, meaning that particular carry trade has done nothing wrong. So that has not been a risk, but I keep watching it. And then last but not least, we do have a steepener of size. And so I want to just show you the biggest threat in the room. All right, now I've shown this to clients every day. They get all this stuff every day, but we only do this once a week. And so I'm kind of highlighting the important stuff. Okay, so this is on a weekly, and this is the 10-year, 2-year yield curve. Now, for those who are not in fixed income, you could care less. But I got a lot of fixed income folks that trade this, and it's also a huge market, right? The bond market is just very important. And so this has been a key chart that I stay focused on technically. And then, of course, I've got the macro, especially classical macro interpretation from Jeffrey, who's brilliant about fiscal dominance, where we have transitioned. Long story short, you can see this is on a weekly. This is September 18th. And in fact, we went positive from inversion. And it was literally that morning. This is September right here. September 18th was the Wednesday where the Fed did their surprise 50 basis point rate cut. And I had literally did a client post that morning, and it says time for a yield spike. And it seems antithetical for the fact that we would have cuts, but the market actually created a 100 basis point raise in the 10-year. But that's exactly what I saw happening. And this is a steepener that I've also been sizing up. Every single one of these has been really technically textbook bullish. This is a steepener. Now, the problem is bear steepener, bull steepener, they don't really work anymore for their definition because we've transitioned from this monetary dominance to fiscal dominance. Now, I know most are looking at this going, well, that just means the economy's getting better or inflation's rising. But this is not bullish bonds. So it's bearish bonds, and it is bullish the longer end interest rates, while the short end is falling, sometimes very quickly, like the past few days when Trump fired Cook. Now, why does any of this matter to equity traders? We're all freaking bond traders. Let me tell you right now, what happens with interest rates when they start to rise aggressively is headwinds to equity advance. So I can't help but wonder if the timing of that 250,000 contracts, which might have just been a rebalancing, maybe it's just normal, I don't know. But the fact that he called it out at the same time this started to freak out higher in the steepener is new information. I knew it was going to do this, and I'm actually very cautious that once we get above this level, it's going to pick up speed to the upside. So let's see what happens. But basically, firing Cook is removal of this Fed independence, which is underpinning the long end and forcing short ends lower in anticipation of rate cuts, which can create this steepener, which in the short term is very good for banks. Banks love this cheap and steep. They love it. So you can see Citibank is hot fire flames. You can see these.
Perfect. Net interest margin. Beautiful.
Oh my
Bring it
God.
on.
And look at this. You can see this stuff. They're benefiting tremendously, and they're still breaking out of wedges. Oh my. But the point is, the rate of change in that steepener is going to start to bite equities. It's not a question of if, just when.
Well, it's more all gas and no brakes, and until something breaks, which is what you're alluding to. At some point, it's a problem. But right now, it is Trump is going to have all his chess pieces in place, and he's going to get his, I think, 125 basis points by next September, October. I think he's probably get it. And then that's going to be just sort of positive. The problem for bears is you're kind of pushing against this sort of boulder. They've made it very clear that they want to really almost supercharge growth to push through inflation and whatever inflation there is, which I think is coming coming down anyway at some point. And so you really just have all these kind of positive things that are going to make it very difficult. And like you always say, you need that macro event, you need something to break. And even occasionally when we see something break, we're really kind of scooping it up very, very quickly. The big V's are still happening, recoveries, and the small V recoveries are happening. If you look at the S&P over the last month and a half, the smaller V's are recovering as well. So it's just, there are forces that are very much in control of this market. Some of the corporate buybacks are probably petering out a little bit here. And from a volatility standpoint,
not until the 14th of September.
The 14th? Okay.
Yep.
Okay.
Yep. Goldman says not until the 14th of September. So we're still in the sweet spot. And I might add, when you're done, corporate issuance is September. It's the most important month of the entire year. So if it's strong, which is expected to be strong, that's the ammunition to fire that buyback gun repeatedly for the next few quarters. So they need corporate issuance to be very, very, very strong in order to fund corporate buybacks. They're connected.
And to your point about financials, that's one of the ones I've been playing since I don't want too much exposure to, at least now, I think it's okay. I think all boats will be floated as this sort of productivity phase kicks in and all gas, no brakes continues to push things. So there's going to be that tailwind from the broader forces here. Eventually, I don't really want too much exposure to personal loans and things like that. So my choice is really just kind of the JPMs, the Goldman Sachs, which I think are just perfectly positioned for taking advantage of all the things that we're talking about right now and this constant put. I mean, what we really have now is this big sort of put in the market, which is probably going to help to keep volatility low. And not to mention that MAG really is kind of a heads they win, tails they win as well in a way, because they're in good times, they do well because they're in all the right places and they're building this new digital world, et cetera, AI, et cetera. And in tough times, they're really the balance sheet heroes and they're sort of the utilities. They're the utilities. We need what they do. And we're going to just increasingly have that need over time. So there's sort of a win-win-win. And that's going to kind of keep maybe a little bit of a lid on VIX, as it often does, until things break enough that there's a correlation that eventually brings down the Microsofts of the world. Eventually, they cannot be immune to everything. And April was a good example of that. So, but I think the influence has to be something really, really breaking at this point. Something's really got to break because everything is kind of pointing to one thing, which is let's keep juicing assets. And then on the backs of, frankly, the economic numbers that are okay, unemployment numbers that are okay, despite the fact that everybody freaked over recent numbers, they're still generally okay. Manufacturing numbers kind of coming back. What was I looking at? The PMI. And then you've got the AI thing, this sort of regime change as this known unknown, as I keep calling it, which is the known unknown, which is everybody knows AI is the thing. The unknown is, well, we don't really know how it plays out throughout the economy. So I think we're really in a period in history for the economy that we don't, and markets that we don't often see. The internet was kind of like that, where we saw inflation was in check. We did have some productivity influence that kept things going. This is that, and it probably times 10 or 20. And so this, I think, is what's going to keep things generally going. And I think the Nvidia numbers, who cares? We'll see what he says. He's going to start talking in a little bit. But frankly, I don't see anything getting derailed. This down $5. Okay, so it's where it was like 5 days ago. Big deal. We'll have to see what he says. But if he keeps saying, which he has been saying unabashedly, which is there is absolutely no slowdown. Nobody else is saying there's a slowdown within range. And so I don't see why that really changes. And so I think it's sort of business as usual. So I don't know if it's time. I really doubt it's time to get bearish. I've been adding some protection. I've been buying some things like SPY 470 puts, some put spreads just to play for the what if, because you never know. You never know. The markets don't always make it easy for you. And you have to find ways that can weather the storm. If you take those massive, massive hits and you don't at least have something that's working out, even if your hedges aren't making up for more than 20% of what the rest of your portfolio is losing, and I'm speaking from a sort of maybe more investor standpoint. If you're a trader, maybe it's different. You don't have a tolerance for loss, and that's a different story. But if you're sort of making some moves that can help, that's going to preserve some of that emotional capital, which I think is going to be important over time as we probably continue to head into this 99 to 2001 period. Maybe we're 97 now. I don't know. I think we're actually very, very early in terms of how AI plays out. So I think you're going to get those. There were some ugly, ugly sell-offs back in the .com, and there will be some ugly sell-offs as well here on the backs of some news. China has figured out AI and some sort of maybe big cyber breach, or I don't know what it's going to be.
Speaking of which, crowd is down quite a bit after earnings after hours.
Oh, is it?
Yeah. Speaking of cyber, just real quick on
Oh
Nvidia
yeah.
data center revenue, 41.1 billion, a little below estimate, just the data center. Remember that makes up a big honking amount of the revenue. It missed in that area. Accounts receivable up 20% quarter over quarter, inventories up almost 50% quarter over quarter. Anyway, but slicing that and dicing that is not the role right here. The point is we have a very bullish narrative going on that is these numbers are ex China. And if that's the case, then everyone is on board with this Nvidia growth train, which must continue to grow 5 to 6% each quarter or else. Conference call is yet to be determined. It's the top of the hour. We'll be done by then. You can all go listen. But in the meantime, I do want to answer someone in QA just kind of popped in and said, what about MDB? So let me just show that screen and talk a little bit about it, not a lot, because everyone is focused on Nvidia, and I have a question about the steepener and all that jazz. So we'll hit anything you want us to talk about. Long story short, I got a screen here of MDB. This is a monster earnings beat. Now take a look at MDB. Someone's saying it's up 30, 40%. Yeah, right now 38%. This is today. It actually opened very, very strongly and then continued higher. So it opened at
Tap and go.
282 and it's now hitting 296. So this is like, oh wow. It is a bullish breakout. There's no question this has been in a strong descending move here all of 2024 and all of 2025 to date. If this can base here and hold, then it is a productive looking chart. But I always warn, since you're asking, this very large descending 200-day is trouble. So even though it can get above, it doesn't stay above. It takes months and months and months before that 200-day flattens out and it's a safe move. So there are particular plays that I've recommended long that are in the process of flattening out and fundamentally are strong. Sector rotation or trend reversal or just really nice swing theta decay kind of plays before they base and move higher because they have to digest this range of a flattening 200-day. That's all there is to say about that. But I will say MDB beat because of some China vaporware. In other words, I'm not really trusting this gap up. So nearly half of MDB operations are currently dedicated to climate finance. China, India, and Turkey are the largest recipients, if you will, of their software and such. So I'm not really excited about that since I think a lot of it might be vaporware. It's kind of like Datadog. I don't know if anyone remembers. We had a very large, excited gap up, and I said that looks like an absolute short. And sure enough, it came down and it has continued to come down back to the 200-day. So I'm not a big proponent of chasing these after hours unless there's a really good reason and the whole market's moving with it and the 10-week is kind of supportive. But otherwise, they're usually really great shorts and continuation shorts after. So we'll see what happens with MDB. It's a little bit different in that it's got a lot of shorts too that are squeezing.
It's getting back to its highs from February, I guess. So it may just have just a touch of trouble right there. But
Unless there's a story to go with it. Like Tim is posting on Unity stock, which has just recovered all of its losses since January 2024. That is a breakout that's also kind of a bottom fishing play that's coming up. It's retraced almost 2 years of losses, but it's a turnaround story. So there's got to be not just technicals, but something that's going to back it up.
Yeah,
Okay.
and you know what? I think what's going to be interesting for us as traders is going to be finding areas where the narrative has gotten it maybe incorrect or perhaps they're ahead of things a little bit. So, for example, in the software space, we've seen a lot of software names kind of get crushed, and even in cybersecurity, where I think there'll be some opportunities. But I put on a play today, so I put on an upside broken wing butterfly in Salesforce. And so for me, this is a name I talked about on one of my shows. I talked about Salesforce, Upwork, Fiverr, Adobe. I called those shorts about 6 or 7 weeks ago and they've gone
Yep.
down. So lucky. I also called LegalZoom a short and that's popped. And I also called Google a short. So I did not get everything right, but you can see that the software space has absolutely gotten smoked. And I think there's an opportunity there. It may be true that over the long run, there will be margin compression a la, Visa and stablecoin and these businesses that have had these wonderful, wonderful profit margins and moats. And there is no other choice except to hire Salesforce or one of the few competitors that are at that scale. I think that over time, that is going to absolutely be truth. And they're going to struggle in some ways, at least from a profit margin standpoint. But in the meantime, the same way they're sort of overdoing what that MIT study is suggesting, that there's just people are expecting maybe a little bit too much. And maybe that's just our human nature. We think that, okay, now this is going to solve everything. No one's going to grab their chat GPT at 20 bucks a month and say, AI, would you please be my CRM software? So I think there are going to be opportunities there, and we have earnings coming up in a few days. So I think that's going to be very interesting. So what I did was, it's not a massive high conviction trade. And when I feel that way, and when I'm not super, super high conviction, I am on the story. I think there's a recovery there, potential from a trader standpoint, but I don't know if it's going to play out right away. So what I like to do is come into it with more limited risk structure, which is the broken wing. So I did a 260, 290, 300, I think it was, in October. And what that's going to do is about I think it was about 675. I'm going to risk $6.75. So on a one lot, 675 bucks. And it's not super, super long delta, which is a nice thing about the fly. If you're really, really excited about something and super, super bullish, then you might put on something a little different, because the flies are a little bit more, even though the broken wings, I like to broken wing it because they lean in one direction. So that is a little bit more aggressive. But I think there's some plays there where we're going to sort of overdo the negative narrative in some areas. I've been short Fiverr. I took off my puts and now I'm long some exposure, thinking that, oh, you know what, they've probably overdone it a little bit here, because I think there's going to be a big demand for automation, coding, putting GPT to work. You can try to do it yourself. It's pretty tricky. Trust me, I've tried. And I have an automation that I wanted to do over the last few days, and I kind of played with it. And then I went, you know what? I'm going to hire some guy on Fiverr for 85 bucks. And he's like, yeah, you're going to do this, 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 and this. So some gentleman across the world is going to help me kindly, kind sir, is helping me for 85 bucks to do something that probably would have taken me 14 hours to figure out on my own. And I would have done it wrong or poorly. So I think there's going to be some interesting opportunities.
You're pushing my hot buttons right now, because you know that I have 5 development teams on 4 different continents right now. So yeah, it's not 85 bucks.
It's not 85 bucks. Well, you're not looking long enough, Samantha. You got to negotiate them down to 85 bucks. So I think those are some interesting plays like that out there where I think they've overdone things. And what are some other things I'm doing? I'm long a little bit of Palo Alto. I've been chipping away at Oklo and SMR, which are going to be a little bit more speculative on the nuclear side, but I truly feel that
it's not speculative, it's early.
It's early, yes, early.
So early is another word for speculative, but no, speculative is crypto. It's this treasury crypto crap. That's speculative. A lot of the nuclear renaissance plays that, I'm very, very, very strong in the uranium space since November of 2020. And I was absolutely gifted with a client who co-founded the Uranium newsletter. So there isn't anybody stronger or smarter in that space. So we've been guided beyond belief with great, great, great trading environment in uranium and all the associated feeders into data center. But a lot of that stuff is early. It's also valuation nirvana. So you have to be able to ride that out or play the swings. And that's all. It's swing and trend trading at its finest, but a lot of people don't have the patience for that. You do.
Well, and things can burst rather quickly. So I don't remember which one it was, but Oklo got to 83, 85, and then next thing you know, it's 61. So you have to have, even within a bull market, you're going to get pullbacks in some areas that get a little bit exuberant. So you have to be either prepared for those or play the swings a little bit, have a put spread. So I've been putting on plays where I'm long, I'm creating like a long call spread, but with a little put spread, or an in the money call, like a leap type play, but with an out of the money put to kind of play for the pullbacks. It's not going to make up for my entire long position, but what it is going to give me is it's going to give me piece to play with in a market that should really at some point have a little bit more back and forth. It's a little bit more up nonstop at this point, but there will be a period, and I'm watching my charts like my ARC versus big cap. There's various indicators. I watch yours as well, Samantha, IWF, and there are a couple little sort of indicators that you want to really watch those relationships. I love those relationships charts. They
let me show you that ratio analysis, because we did this, was it last week? I can't remember, but yeah.
Yeah, guys, if you're not looking at stuff like that, you're missing out on a very crucial point, which is you have to zoom out a little, because that's going to inform your shorter term trades. Remember, short-term trading doesn't exist in this vacuum. You are beholden to larger themes and trends, big money. And what the relationship charts give you is an idea of where that big money is moving into. It doesn't mean it can't pull back, but when a ratio is in breakout mode, you want to be really aware of that in the back of your mind as part of your overall strategy, I think.
So this is what you're referring to, and it's kind of ironic because we were talking about, okay, we were hitting resistance right now. It's a good time for growth to peter out, just take a pause, however you want to put it, and for value to pick up. And then everybody became Tom Lee fan for 1 week. And basically that's exactly what happened. We had a rotation out of growth into value. This is why I specialize in sector rotation, because then I can see, okay, gold and silver and miners, we've got a trend reversal in play. We've got a swing long. They're not just multi-day, multi-week, they're multi-month, multi-year. So I'm very, very, very focused on growth value rotation. And this is an example where, remember, we talked about this and I wrote about this. We're going to pull back July 31st, big stack that comes off the board, and then into August 15th and August 20th, VIX expiry. And that was your growth momentum, basically taking a pause, and value picked up. And now we bounced, by the way, on Friday, right at a kind of this is my handwritten annotations, but the point is we bounced right at support. We need to break 2 levels of support in order to come back down and for Nvidia to be a solid short at 172 into 152. I care about 10 points, not $1.10. So 20 points. Duh. Anyway, the point is I'm very focused on bigger moves, but this is going to be in play right now until it isn't. In other words, we're still haven't broken down, and Nvidia still could get supported at 172, and the market is still at all-time highs. You don't short all-time highs, you don't buy all-time lows. So I'm still looking at sector rotation, but I am aware of divergences when they start to peter out underneath the surface, etc. So anyway, that's an update to that particular ratio analysis that we were both talking about in a prior whatever iteration.
Well, and we've got all these calls now coming. Okay, now is the time for value. Now is the time for small caps. And it has been, they've rallied. Now is the time for some of these things that have been downtrodden for a long time. Whether that continues to play out, in my view, I think it's a bit more of everything can probably do okay in my roaring 20s scenario, which is going to be rates are finally going to come down. I think I'm going to be horse out of the barn at some point. Whether that plays into the 10-year where we want it to, it may not. I mean, we've seen this before where it doesn't exactly work out the way we thought it would last August. But I think this is going to, that and productivity boosts are going to provide something very beneficial to the rest of the economy, to the rest of the S&P 493, which trade at a much more reasonable valuation. Now, does that mean you short Microsoft and Nvidia? Absolutely not. They're still building. They are the utilities with growth. Utilities with growth are very difficult things to short because they have incredibly strong secular reasons for their strength. And really, frankly, I mean, Nvidia is not expensive. That thing gets down to into the 150s. I am absolutely, mortgaging my mom's house. Maybe not my own, but I will ask my mom to mortgage her house to buy more and more and more because they're in the right place. And we're just really getting going on this inference at scale. Nvidia came out with a robotics chip the other day, and they're going to be pushing that. So they're everywhere. They're at the edge. They are literally everywhere. Are there going to be
just remember the
competitors?
caveat
Absolutely.
to all of that cheerleading, okay? They are losing the market in China. It does matter. And their associated tentacles in everything will also translate to this ecosystem of AI losing the market in China. So that growth engine is absolutely not stalling. It's stopping. They're creating their own. I know I've said this for months and months since the DeepSeek event and whatever it was, January 14th, 16th, and I wrote about it at length, the Manhattan Project 2.0. They are reinventing at a faster pace because they can. They've got the smartest brains. They've got unlimited incentive by the government to do so. And now the government is saying, you will not purchase outside China.
Yeah.
And now everyone's going, oh no. Now, the reason Nvidia came out and said, and will hopefully say at the top of the hour, we're not worried about China. We got enough going on here with US CAPEX. Well, CAPEX has never been a long-term solution to growth, by the way. Very much what happened in that 1997, 1999 into the top of March 2000 before a 90% fall. This CAPEX buildup is a monetary illusion, which is short-term, very, very beneficial to valuations. But then what happens? Cash flow starts to get cut in half, and then that gets cut in half again. And then we have margin compression, and we have have growth markets that go away because the revenue is not there. So yes, we had a wonderful run up into 2000, and then it took us however many years to make it back, 13, 14, 15. And then of course, we're enjoying all of this now, and we have recency bias, and we're thinking, oh, everything's going to be great with AI. It could take a while. Anyway, so China is definitely not going to be a money source for Nvidia like it was. And that's not priced in. So anyway, we're going to go because you've got Jensen, and some people want to listen to these bullish guidance, demand driven posts, and all is well, because you don't want the alternative. You don't want this concentration risk, especially in the AI darling, the golden child, to become unwieldy and fall. And then, of course, we can chase short into 152. That's easy. What it does at 152 matters. We'll see what happens. But long story short, we still do have a bullish backdrop, although there is some option structures that have happened, like I pointed out from Jason of Volland, that is a little bit suspect. We haven't even talked about precious metals, oil, any of that stuff. But on your question of the steepener, I know people don't keep their eyes on that very much, but it will be an issue. We do not have a Japanese carry trade. And I had mentioned that for the past few months in my intermarket going, it's not a thing right now. It's not a thing. Don't worry. I'll let you know when to worry. We're not there yet. And we're still not there yet. But the steepener, that's different. It might be interpreted as, yes, higher inflation, which is good for wealth assets, but it's not good for consumers. They don't have the assets to inflate away their spending power. This is a big problem for the consumer loans, consumer spending. So be careful. This will come back in also joblessness, and lack of spending will start to show up toward the end of the year. That is my continued belief. But long story short, the steepeners, the big worry, and then some option structure that happened under the surface. Let's see how the market reacts to Jensen's conference call. And then, of course, getting underneath that 172, you got a 20-point at least swing short. And I think that's
and wage pressures too, Samantha. I think there are going to be real challenges on the employment side, shrinking wages, maybe not in the AI space. I think there's going to be plenty of demand in the certain unique places, but not broadly. And that's going to cause some problems in the longer run. So I think the question is, how long is the AI honeymoon going to last? Because there will be some implications, negative ones at some point. I agree with you.
And in answer to your question about healthcare and ISRG, Dr. Gilbert, we have a dedicated, phenomenal biopharma analyst on our trading desk. You get access through, this is Dr. Alex Kenton. He actually was a client years ago, and then we coordinated on some of his deep dive analysis. He does a great job of assessing, and he's a great trader too, but assessing the science, the management, and the market share of any stock. He's an amazing resource. I can't do that. That's not my wheelhouse. It's not your wheelhouse, right, Hans? Very, very
No. You got to have experts. We're very fortunate to have some incredible talents. You have to have that to have a stacked team like that.
So to answer your question, I could look at your particular pick was in fact a swing long that turned trend long. It's going through some distribution right now, so it depends on your time frame. But that's the kind of stuff that we size up custom in LaDucTrading. And remember, we've got a fabulous options course authored by Hans and mentorship also on our LaDucTrading page. And then, of course, we have our full service and 10 subject matter experts. So we're going to wish you all a great afternoon, end of summer. Enjoy your last long weekend before, kids are already back to school. The bus is right in front of my house. So basically they started today, and it feels that way. It just feels like, okay, let's just wrap it up. And everyone's going to come up off the beach and start to push this market one way or another come mid-September.
Ready for the FOMC. The FOMC, Samantha. Look at historically, a rate cut isn't always the best thing in the world. So
yes,
I think
true.
I think that's kind of the signpost that the market will be looking towards. Usually reacts before the date, because that tends to be everyone's waiting for the day. So I think we're going to have some good fireworks over the next couple of weeks. So you want to be paying attention. See us. Be here next week on Wednesday.
All right. Cheers, everyone. Bye.
Bye-bye.
Subscribe to LaDucTrading YouTube channel for more macro to micro options power hour and other content.